Hey everyone, thanks for the time today. Look, the goal of this presentation today is to give you guys a little bit of sense of where we are in terms of where the industry is in its cycle, a little bit about Pantera and how we invest, as well as to give you a little flavor into why we do think it's such an interesting time to engage in the industry. First, a little background on myself. My name is Cosmo. I'm the portfolio manager for our liquid token strategies at Pantera. That means our hedge fund and our other active vehicles. Really, my background comes from traditional finance. I started in New York in the investment banking group at Evercore before doing a few years of private equity at Apollo, before going to a Tiger Cub hedge fund for most of my decade covering long-short equities. So I really come from that traditional fundamental value investment background. And frankly, that's why I found digital assets and think they're so compelling today.
I'm working.
No, all good. Yeah, and just to give you guys a sense of why I decided that now's the time for someone with a fundamental bent to come into the space. As you think about, and you guys have heard from a lot of people throughout the course of these presentations, there's infinite things that you can invest in. There's a lot of places you can spend your time. And the hardest part is filtering for where you're going to get the highest return on time. That's honestly the toughest part as an investor. And so as I think about that, my framework has always been three things. It's one, where is there the most secular growth? Two, where is there the most misunderstanding? And three, where is there the least amount of competition? And it's just so very clearly digital assets today. If you think about secular growth, we're going from maybe tens of millions of users today to billions over time if the technology works. From a misunderstanding perspective, I'd say myself versus just my colleagues at Apollo or my colleagues at the prior fund would totally disagree on whether any of this will ever matter. So the degree of misunderstanding is extremely high. And then the level of competition is very low. There are very few large institutional funds with serious investment processes that are attacking this industry. And so if you can be one of those or be aligned with one of those funds early on, you do have the opportunity to generate meaningful outperformance if this industry does succeed.
Okay, I found the presentation. Let's just keep on going and I'll get
to
in 2 seconds.
And so so that's why I think it's so compelling. That's why I've decided to move from long-short equity into digital assets. As far as Pantera, I joined Pantera last year to lead our hedge fund. Pantera is one of the oldest and most established blockchain dedicated investment firms. Our founder was Dan Moorhead, who's the former head of macro at Tiger Management, the OG Tiger back in the 1990s. He started this fund in 2003 as a global macro shop before transitioning to be blockchain dedicated in 2013. The reason we went all in on blockchain then was we started the first Bitcoin fund and the first blockchain dedicated venture fund, which is returning well over 10x. Since then, we've launched multiple different vehicles across both venture and public, both active and public. We're fortunate to have raised over $5 billion of assets under management today, with employees across 4 offices globally. And we backed many of the leading protocols in the space and, with over 10 or a dozen unicorns in our portfolio. We sort of view the blockchain industry as there are many ways to tackle investing in crypto. You can either go with our venture vehicles, our closed-end venture vehicles, which are, we're currently fundraising for our next vehicle right now, or our open-ended liquid token fund, which is effectively a public liquid way to approach digital assets, which is our liquid token fund.
Are we running?
Oh, great. Yeah, and next slide, and then next slide. And these are the list of our funds. So look, moving on to the next slide, and then I don't know if this is the right presentation.
It's the one that I have.
Okay, got it. Let's work with it. That's fine.
That's great.
Yeah, I mean, look, I think really what we've done is that we have strong deal flow. We have strong deal flow from Jiang for a long time. It's a pretty value-added platform because we have all these platform services, much like the other large venture funds, except we are blockchain dedicated. And we have strong technical talent and leadership from all the top firms such as Bridgewater and Apollo and others that have joined the firm to help grow this asset class. Next slide. Let's see what we got. This is our executive team running through them. Next. And these are our variety of funds. We have our venture style fund, we have our early stage and liquid token funds, and then our passive Bitcoin fund.
So can you talk, since you run the hedge fund aspect, can you talk about what that group does? And
yeah, sure. So look, the core of the strategy of what we're trying to do in digital assets, I think one of the main things that people should understand is that tokens are a new form of capital formation. If there's one thing that you guys come away with from this is that cryptocurrency is sort of a misnomer for the universe. It's moved on very much from just being Bitcoin and other currency-like tokens. Now, the reality is many businesses will never have a New York Stock Exchange listed equity. They will only ever have a token. And that token is how they align incentives with management teams, employees, token holders, and uniquely to digital assets users. And so many businesses are token-only businesses, and they have, we call cryptocurrencies or digital assets, but though they are liquidly traded in the early stage of their life cycle. So what is unique to crypto, to digital assets, is that you get to invest in these venture-style outcome companies because they have to go public or go liquid very early on in their life cycle, but you get to do it in a liquid context. So the liquid token fund that I manage is dedicated to investing in the very broad universe of digital assets. To give you a sense of what the picture looks like, today there are about 500 digital assets or 500 tokens that trade over $100 million market cap. And that's a pretty large universe of investable names. Within that, the reality is that I think that we're at a point in the industry cycle where, the way we approach that is really with a fundamental bent. So what that means is we are doing a lot of the same work you might hear, Wall Street analysts or research analysts do for equities, which is we're building out financial models, we're talking to management teams, we're really understanding the product and why the product should exist, and then modeling out what is the ultimate 3 or 5 year returns that we can get by investing in this product based on the cash flow it can generate. And these cash flows often do accrue to these tokens. A lot of these tokens, whether it's Ethereum or Solana, they actually do issue dividends and they do buybacks. And so a lot of these tokens actually look and feel a lot like cash flow returning equities. And that's why you feel it's so interesting to approach it with a fundamental bent. Our liquid token fund is, as a classic hedge fund style, we're trying to find the best assets out of this universe of 500 plus cryptocurrencies. We're investing in about 15 to 20 core positions with overlaid with a strong risk management of really trying to generate outperformance and benefit from the secular growth tailwinds of the crypto industry.
So these are typically cryptocurrencies. Does this also include asset-backed tokens?
So it's a great question. So the digital assets in the universe is so large and it's become very complicated, and everyone sort of groups things in the same way. But what we are focused on is tokens that represent protocols, and protocols are effectively, you should think of as software companies or other businesses that create products that generate cash flow. Many of these protocols also do have tokenized assets like mortgage-backed securities or artwork that place on chain. And those are assets in themselves, but the tokens that we're focused on are ones that are basically software companies that generate cash flow, are growing rapidly, and sort of supporting this large universe.
And that's like Solana, Ethereum.
Right, that's stuff like Ethereum, that's stuff like Solana. There are financial applications such as there's an on-chain bank called Maker. It's got about $5 billion of deposits. It makes 4% NIM, very profitable business, growing 50% quarter over quarter. There's exchanges like Coinbase exists on the New York Stock Exchange. Instead, on-chain, we have exchanges like DYDX or Uniswap. DYDX trades at a 10% dividend yield. It grew 20% quarter over quarter last quarter. So there are these very exciting businesses that are built on-chain, returning dividends, returning cash flow, and that's what we're focused on.
And do you stake these tokens?
Yeah. So what is unique about digital assets is in order to earn these dividends, in order to earn this cash flow that's produced, you do have to stake your tokens, which means to effectively it's not so different from just participating in the network. It's a very straightforward process, but we do actively participate in the on-chain economy, and that's what allows us to earn the cash flows that these protocols produce. So the goal really here is our goal is to create the next Viking or Lone Pine of crypto, and we think it's very possible to do that because there is such a rich growing universe now of tokens that you can invest in. I think a lot of people think of the crypto industry as just Bitcoin. But it's really important to realize that it's actually a lot more diverse than that. The total crypto market cap today is about $2.5 trillion. Yes, $1.5 trillion is Bitcoin, but there's actually $1 trillion of mid-cap, small-cap companies that exist. And those are that 500 plus universe that I'm talking about, and that we're really focused on investing in. What you see over cycles is that we're sort of at the beginning of a return in the cycle this time. If we think about the last few years, just to walk you through the arc, I think everyone here in the crowd would agree 2022 was a very challenging year for the crypto industry, and frankly for all industries. Just correlation of everything 1-to-1 when rates started going up, and the crypto industry suffered. It was really a year of bursting of speculative excess across everything. It was a real come to Jesus moment for people in crypto, in addition to other asset classes. but that was healthy. And 2023, though, was really all a year about these headwinds starting to hit the industry because of what happened in 2022, whether it was the regulator coming down hard on crypto companies because they had underreacted in 2022, so they had to overreact in 2023, whether it's users who had gotten hurt and a lot of people lost money in 2022, leaving crypto in 2023, or it's capital, just capital flight because a lot of allocators lost faith, or a lot of companies took on too much leverage and went bust. So 2023 was a year of headwinds really buffeting the industry. 2024 is really a year about all these headwinds becoming tailwinds. Whether that's on the regulatory front, we've seen over the last 6 months, the SEC has lost every single one of its cases against crypto companies in court because under US law, they actually do not have grounds to accuse the crypto companies of what they've done. Yes, there were many frauds, but the SEC has overreached by a very large extent. And so they've lost every case.
Could you repeat that? What was the reason why?
Yeah, because the SEC is right now overreaching in terms of calling all these cryptocurrency securities, or saying that they're offering unregistered broker dealers, when the reality is that these are new assets. We need a new regulatory regime. The industry and I want a new regulatory regime, but instead the SEC is saying, there is no you guys are violating the law. We can't tell you which law because the law doesn't exist yet, but you're violating the law.
Well, I'm surprised at that because the definition of a security is generally so broad, and I haven't actually been following the crypto.
Yeah.
I've been actually trying to ignore it because
Yes.
I just a sensory overload.
Sure. Yeah.
And I'm afraid if I don't, but as far as the court decisions, I'm actually surprised at that because the SEC, my brother-in-law used to be branch chief of enforcement
Yes.
here in Los Angeles.
Yeah.
And so I worked with him and we were both subtenants at Greenberg and Gloucester.
Oh, great. Yeah.
You know, in that building right over there. But that definition for them to lose those lawsuits.
It's pretty wild. Yeah, the Southern District of New York has ruled against them 3 times this year in different cryptocurrency related cases because they have overreached in applying the definition of security in the case of cryptocurrency.
So what is the regulatory regime then for like a, Solana or something like that? Or...
Yeah, so right now, unfortunately, the regulatory regime is very unclear. You can view that as both a good or a bad thing. The bad thing is that because it's unclear, it's caused a lot of entrepreneurs to leave the US and start these businesses in Singapore or Dubai or the UK. And we've actually lost a lot of really great talent from the US to these other countries over the last 2 or 3 years. And it's obviously bad because it scares away investors, right? A lot of investors are afraid to interact with this asset class because it's not fully regulated. The good is that that's all opportunity. Like everyone in the industry, in the cryptocurrency industry, our fund, other funds, we are begging the SEC to come out with rational regulation and to help us regulate this industry because it's important. Like we want to protect consumers, we want to protect users, and we just want certainty. And if we have certainty, entrepreneurs will come back and they'll start really large business. There are dozens of unicorns in crypto being started outside the US because the SEC won't engage.
So it's not a good thing.
Right. So the lack of regulatory clarity is not a good thing today, but it is an opportunity, right?
Pushing the price down now.
Right. So
does Pantera invest abroad though?
Right. So as a result, the majority of our investments are in these protocols that are based abroad or businesses that are based abroad. We'd love to support US entrepreneurs, and we do for sure, but many of them are abroad.
So you have like a master feeder structure and the investment comes from Cayman, not from the US?
Yeah, that's right. We have, I guess, very classic fund structure, our Cayman Master Fund and domestic and offshore feeder funds. That's right.
But when regulations do kind of give you some guidance, your investments are now overseas, which don't have the guidance.
Well, so what's funny is that the SEC, the US is actually the most behind in cryptocurrency regulation globally. Most other regulators are very open and have created regulatory frameworks, whether in the UK, whether in Singapore, Hong Kong, or Dubai. They all are encouraging digital assets innovation. They all are starting to create regulatory laws. And that's why these management teams are going there, because they have this.
I think the USA wants it to remain murky. There's a purpose in that.
Yes, that's right. I think the US wants it to remain murky. I think a lot of people believe that cryptocurrency is bad for the US dollar. I think it's very surprising, but almost everything in the digital assets or crypto industry is denominated in US dollars, even abroad. So if anything, the crypto has really increased the US dollar's hegemony over the globe because everything in crypto is denominated in dollars. Everything is settled in dollars. And this perception that like it's murky and there's a lot of nefarious activity is just not true because blockchains are by nature transparent. You can see every transaction that's on chain. Most people go through KYC venues like Coinbase. And therefore, the FBI and our CIA actually have ties and have direct lines into all these all these protocols. And so it's actually very hard to get away with any kind of fraud in crypto.
So staking a token is a lot like being the seeder of a fund, I think. Is that correct? Or
In some way,
maybe you take people through the staking process and talk
Yeah.
about how much you stake as a percent of the initial investment, and then what the gain is, and at what point do you realize a gain from that staking?
yeah, I think what goes back to this is at the end of the day, these cryptocurrencies represent networks, and the networks need people to participate in the network in order for a network to have value. One way to participate in a network is to say, hey, I'm a token holder in this network. I affirm that everything is being processed correctly on this network. And by doing that, and by staking my ownership in this network, I'm attesting to the fact that everything is going fine in this network. So
You're buying tokens. What you get in
You
return
need
by
to-
staking is you get tokens.
right, you need to purchase a piece of the network to participate in the network, and you stake to say that, hey, everything here is going fine.
Who's doing that due diligence? How do you do that due diligence?
That's so there are a lot of
Relying on
fun.
somebody else to do it for you.
Well, I do the due diligence, right? I'm doing the research and figuring out what these protocols do, how they generate cash flow, and the beauty is they are fully transparent. Every single transaction that happens on a blockchain is printed on the blockchain. And so you can see, like we talk about financial reporting being quarterly for public companies. Financial reporting for blockchain businesses is second by second. Like I see the revenue second by second for all my portfolio companies on chain.
When you stake the token, you receive 10% of the tokens. Is there like a typical amount?
Yeah.
of tokens you receive?
So staking is not a huge piece of that strategy, but we definitely do it in some instances. For Ethereum, it depends on the network and on the valuation of the network. In the case of Ethereum, you're receiving, if you stake your Ethereum, you receive about a 3% staking yield and about a 4% total return, because Ethereum buys back about 1% of its stock or 1% of its tokens every year. If you're staking something like Solana, you're receiving about an 8% staking yield for staking your Solana. And the DYDX example I gave earlier, which is the on-chain exchange or the Coinbase equivalent on the blockchain, you're receiving a 20% dividend yield or staking yield for staking your tokens.
Do you think the US government is concerned about cryptocurrency undermining the US dollar?
Yeah, yeah, exactly. So I think that's what's really interesting is that almost everything in cryptocurrency industry is based on US dollars, and the CIA and the FBI have been known to be fully plugged into all the stablecoin issuers. So there's actually full transparency of everything that's used for that's US dollar based in the crypto industry, which is more than 95% of it. I think the US is, if you actually listen to some of the Fed Reserve governors, not the current chairman Powell, but like some of the Fed Reserve governors, they've started to publish papers attesting to the fact that, wow, actually this is positive for the US dollar. It's really increasing the dollar's adoption globally because everything in crypto is denominated in dollars. You go to the Hong Kong Stock Exchange, it's denominated in Hong Kong dollars. But if you trade Bitcoin in Hong Kong, it's denominated, you go to the Hong Kong Stock Exchange, everything's denominated in Hong Kong dollars. But if you trade Bitcoin in Hong Kong, you're trading in US dollars. So it's been very positive for the adoption of the US dollar. But people are afraid because it's new, and so I get it. And so it's just all about an education process, and we're starting to see
But
that.
it's a means of exchange that you can transfer and create liquidity and carry with you in your pocket that
Right. Which
can't
is
be
not
inflated like the dollar.
Right.
Right, and so there are some cryptocurrencies that are immune to inflation because they have limited supply, like Bitcoin. And so you're welcome to change from dollar to Bitcoin, but we all know Bitcoin is like digital gold. Not everyone's changing their money to gold. People want to spend in dollars. People have money in dollars, and so the U.S. Stablecoin market, if you will, which is U.S. dollars on the blockchain, is now $200 billion of U.S. dollars that exist as stablecoins on the blockchain, and those are all again fully trackable by the Fed, and so fully compliant, and really what's driving the crypto industry.
But how do you address, like, for people who want to express their interest in Bitcoin, how do you address the not your keys, not your Bitcoin? Is it just that you have to tell them it's not a trade, it's just a trade?
Yeah, I think well, the crypto industry has not done itself a great disservice by making it very hard to interact with cryptocurrencies. Historically, there is this phrase, not your keys, not your coin. The idea being like, Bitcoin is the ultimate arbiter of sovereign wealth. Like no foreign nation can take it from you. No centralized entity can take it from you because it exists in this network that's controlled by no one. And that's beautiful. That's great. It's true. It is censorship resistant. In order to really do that, you have to hold the keys yourself. I think the reality is most people trust centralized entities, and that's okay. And so, and especially in the US where the rule of law has, for the most part, worked well. And so, I think for, if you're in Argentina, or you're in, if you're in Iran, you're probably going to keep your coins and your keys yourself. But if you're in the US, go buy BlackRock's Bitcoin ETF. It's been home run, right?
How do you address custody for that?
BlackRock custodies their Bitcoin with Coinbase, fully regulated by the New York regulator. Like, so all these, you are trusting that if you buy Bitcoin through the BlackRock ETF, you're trusting BlackRock, you're trusting Coinbase, and you're trusting the New York FinCEN. But most people in the US are going to make that choice. If you're in Argentina or if you're in Iran, you're probably not going to trust your regulator, and so you're probably going to go buy Bitcoin yourself.
About 5
I'm not
minutes.
concerned that at some point BlackRock owns more than 51% of Bitcoin.
I think that's pretty unlikely. I guess it's possible, but it's pretty unlikely. I think just mathematically, because of how markets work, as you buy things, price goes up and it gets harder to buy the next Bitcoin. But to give people a sense of the magnitude, so far this year to date, we've seen $30 billion of inflows into the Bitcoin ETFs since the launching in January. That's pretty meaningful. To put that 30 billion sounds like a lot of money. What does that even mean? That's 2x the amount of dollars that have gone to the S&P 500 year to date. So 2 times the amount of dollars going into the S&P 500 have gone into Bitcoin year to date. That is how much demand there is for this type of asset and for this industry.
That's just this year.
That's just year to date from January to now.
Here, right, that you keep a tally on the transactions,
Sorry?
you keep a tally, a history of what is going on.
That's right. The blockchain is beautiful because you get a transparent record of everything that's going on. That said, like if you're trading through, the BlackRock ETF, which to the gentleman's point is actually in a centralized entity, and so that does not go on the blockchain, and that part is not transparent. But to the extent you buy your Bitcoin yourself or any crypto yourself,
Follow the blockchain model, because the blockchain keep a tally of everything.
that's right.
In 2-3 years, where Bitcoin doesn't do that, and that's my question. How do you calculate that?
Yeah, as these blockchains gain more history, they clearly have a very long history of transactions. There are many different ways to store these transactions in a decentralized way. Many people don't store the full history of Bitcoin transactions on their computer because that's crazy. But there are enough people that do, that are distributed around the globe, that you can create, this trusted third-party history. So it does exist, maybe not in everyone's hands, but it does exist.
About 3 more minutes.
Do you have a slide with performance of funds 1 through 4?
I don't know. I don't know these slides because it seems like we sent the wrong PDF, but we can definitely share it with the group afterwards.
Because 10x returns.
Our venture funds have returned very well. Our first venture fund returned over a 10x. Our second venture fund, which is a 2015 vintage, has returned over 6x. And our third venture fund is around a 5x, and our most recent venture fund is 2021 vintage, so relatively early, but around a double in the last few years.
So you were calling capital during
2022, most of the capital was called in 2021 and then 2022.
Did you find that a lot of that you and your competitors did not draw capital at 23, which would have been probably the best time?
Definitely a lot of people, it's hard to speak to other competitors because we just don't know for sure, but for sure, a lot of the blockchain investment went down a lot in 2023. We kept investing throughout 2023 and certainly through 2024. The liquid token fund that I manage has definitely gone through its ups and downs. It's a very volatile industry. And we've overlaid new risk management tools since I've joined. I joined the firm in August, again, from sort of, established long short equity fund. And since August, we've turned over 200%, which is pretty good.
You have short range, medium range, long range predictions that you want to share?
We definitely don't give price targets, but like I'd say, over the medium term, I'm very bullish on the Bitcoin, on the crypto industry. With Bitcoin, we're seeing increased ETF flows coming in, which is obviously positive for price action. We're starting to see a lot of entrepreneurs come to the space. If you look back historically, whether you measure trough to trough or peak to peak, the Bitcoin and Ethereum have catered at about 35 or 40% a year, which is, pretty good. If you think that might happen going forward, that's possible, but that's certainly what they've done the last 5 years. Or the last 10 years, they've catered at 60 something. So it's certainly, it's not for the faint of heart because they also drew down a lot in 2022. Bitcoin drew down 50 and 50, Ethereum drew down 65. But again, trough to trough, they cater at 35 to 45%.
And are you living in Puerto Rico?
I live here in Santa Monica. Our team is distributed across the US mostly. Our venture team sits in San Francisco. I'm here, but most of my team, which is the hedge fund team, sits in New York, where the center of a lot of that goes on.
Okay, great. That's Jeff Lewis.
Jeff Lewis, yeah, one of my partners.
Yep.
Yeah.
How much is in your fund?
Yeah, our liquid token fund right now, we have a couple different strategies. In total, we manage about $650 million of active liquid strategies. And then our fund that we're open right now is about $200 million of assets.
How many people manage?
It's myself and a team of 3 analysts.
Are you able to do any arbitrage?
So the goal of our strategy is really like long-term investing and long-term compounding. We're trying to find, the next Google, the next Amazon that could be built in digital assets. So we're playing for 10 baggers, 20 baggers, 100 baggers. And so arbitrage, we do a little bit, but frankly, that's just not where we're not in it to make a few points here and there. We're in it to make doubles and triples and quadruples. So
Fantastic. Well, listen, thank you so much.
thank you.
Great job.